everybody. Thanks for joining us. I'm Tommy Norman, Chief Agility Officer here at Ackland Avenue, and today I have Ezra Mehlman with me. We're going to talk about product development, product companies, investing, when to invest, maybe the dreaded R word, recession, possibly today. So Ezra, real quick, give everybody a little introduction to you and your company.
Sure. Well, thanks, Tommy, for having me, and thanks to the folks at Ackland Avenue. It's a pleasure to speak with you. So my name is Ezra Mehlman. I'm a managing partner at Health Enterprise Partners. We are a healthcare IT and healthcare services focused growth equity firm based in New York. Among our key distinguishing characteristics is that about 2/3 of our capital comes from the healthcare industry. So we've aggregated capital from hospital systems and healthcare insurance companies, along with some financial investors. We use this base of industry limited partners to help us target investments, companies that are responsive to the needs of hospital executives, health plan executives. We use them as a sounding board during diligence, and the types of companies we invest in are businesses that are small, but not startups. We kind of distinguish ourselves from a venture capital firm in that regard. We're making essentially two types of investments, investing in healthcare IT and tech-enabled services companies that are typically north of $5 million in revenue, growing greater than 50% a year, gross margins kind of in excess of 60%. And then we're also investing in single-digit EBITDA healthcare services companies. We like to think that that allows us to have a balanced portfolio between some sort of more mature companies and some earlier stage kind of growthier investments as well.
Sure. So when we're thinking of growth stages, a lot of companies, you said, like startups, they're in their prove the idea stage. And that's not something necessarily you're looking at. They're looking at early funding, maybe angel investment, that type of stuff. You're looking at someone's a little bit more mature. They've gotten in to prove the product, prove the market, and they're really expanding. Is that a fair statement of kind of what growth stage you're looking at, or maybe a little bit further?
Yeah, I think that would be a fair assessment. The way we, kind of think about things is, and we don't get any credit for originality in, kind of laying this framework out there. But if there are sort of three types of risk that one could take, in an investment or that present themselves along the trajectory of a company. Market risk, being, is there an established, TAM? Is there product market fit, a willingness to pay for this company? Product fit, does the product, reliably work, greater than 90% of the time? Is this a scalable product with, proven unit economics? And then execution risk, can this team with, added enhancements, augmentations, kind of take this business to the next level? If those are the three kinds of risk: product risk, market risk, and execution risk, we're really looking to index on that execution risk. So to find companies that have achieved a minimum level of traction along those first two dimensions, demonstrate that they have a reliable product, demonstrating that the proverbial dogs are eating the dog food, and then with our capital, with our help and with by partnering with the entrepreneur, can we kind of take this business to the next level?
So, you and I talked before that there is, possibly an economic downturn, possibly the R word, recession, floating out there, and that sometimes dries up this type of capital. So one, what are you seeing with that? Is that kind of making people nervous? And then if that kind of reduces what's available, how would a company that you just described better position itself to attract and retain funding from a company like yours?
Yeah, it's a great question. Not being an economist, and understanding that recession, it can be used as a technical term to, describe, sort of a pattern or a sequence of certain really specifically defined events occurring. I'm not probably qualified to weigh in whether or not we technically are in a recession or not. But what I can say is that there, are a couple of phenomena occurring within, our sort of corner of the market. So one thing that is clear is that every year from 2010 until 2021, largely without exception, there's been more capital invested into healthcare IT. If there was less than $1 billion invested in 2010, there was $28 billion invested in 2021, maybe 30, depending on whose numbers you use. And what has happened is, 2021 through the first half of 2022 and looking at what is likely to happen in the second half of 2022, 2021 to 2022 will be the first year that there's been a marked reduction in the amount of capital that is going into healthcare IT. And so the question is why? Well, we can look at the public market, indexes, which, a lot of people, have been discussing. And, it's clear that, the SaaS, index has dropped by something like 2/3, since the beginning of the year or since its high point at the end of last year. And the digital health index has, experienced an even more precipitous drop. M&A has declined, both deal volume and deal count since last year. So I think you look at those factors, reduction in the amount of capital going into growth stage companies, drop off in the public market, trading multiples of these businesses from, say, 11 times revenue, 11 times calendar year plus one revenue in the second half of 2021 to something like 2 times calendar year plus one revenue now, and a contraction in M&A. I think that we believe that there are pretty clear implications for growth stage companies. And again, we don't get credit for originality with this. I think a lot of boards across the country are grappling with these same type of forces, but one is clearly doing more with less. Projecting that this period of capital market uncertainty is going to last, beyond a couple quarters, and that there's not going to be a reliable external funding source for a lot of companies, anytime soon. And so thinking through, what is that path to break even? How can we extend cash runway beyond the beyond what we had projected at the end of last year, assuming that there could be, the possibility of raising an additional follow-on round of capital. Well, if that possibility is now more remote, given what's happening in the capital markets, thinking through how to extend cash runway. Part of that is, on the revenue side, thinking about, customer prepays, perhaps ways to get more cash up front at the expense of total contract value as an exception. And then there are a number of expense related factors, beyond sort of just pursuing reductions in force and austerity measures, which a lot of companies, of course, highly publicized, have done, and all over Silicon Valley, not just venture-backed companies. I think one is, and relevant to this conversation today, switching from kind of fixed assets, fixed costs to outsource talent. And thinking through, ways that one can make spend in key areas more of a variable expense, especially when revenue and revenue growth in this particular environment, whether or not we are in a recession, might be less predictable this year than it was in the last few years. And then I think just being flexible and able to pivot more quickly. So we always try to have our companies maximize optionality at every sort of juncture of their growth. Maximizing optionality is the product of not having too high a monthly burn rate and not having raised too much capital in general. If you have a lower burn rate and you haven't raised too much capital, you can consider things like a merger, like pursuing an early exit, like raising more capital for a very specific reason, other beyond just because a lot of companies could raise more capital. And I think we think that those are key sort of implications for entrepreneurs in this environment. Sorry, I know that was a bit of a long-winded answer.
That's all right. So there's a couple of things I want to double back to in there. So one, you talked about, there is a shrinking availability of these funds. And you talked a little bit about how you might make things work without capital, and tighten the ship up. One of those things you talked about was, possibly using, do I hire a whole bunch of full-time FTEs to do product development for me, and do I outsource? So now be a little self-serving with Ackland, since we do outsourced agile teams and staff aug. When a company's looking at making that decision, when you're looking at their book specifically, if we are to get back to someone you're looking at that might be attractive to invest in, I'm assuming that is something that you're looking at in the books. FTE, is in a different column than a contract service. I can easily let this go. This is a little bit more expendable and, like you said, flexible. Is that something for someone you kind of at the end mentioned, burn rate versus how much capital they have? If some of that burn rate is tied up in FTEs, is that a little bit more of a liability than if it's contract services that they can kind of scale up and scale down as the company needs to? Is that more attractive?
Yeah, I think that I think the answer to your question would be it depends. I believe
that's an answer for everything, right? It depends.
Right. I think that it is attractive to companies to be able to scenario plan in general. And you have a lot of that going on right now, which is, businesses saying, look, if we, are fruitful in raising capital, we can put the foot on the gas and make these really deliberate investments, in the business. If it's more challenging to raise capital, or if our revenue should fail to materialize at the anticipated rate, these are the specific ways that we're going to scale back costs. And in that regard, having a flexible kind of variable type of staffing arrangement along the lines that Ackland might provide would be clearly, a benefit that, all the implications of doing a reduction in force and the loss of morale and the complications associated with that, a company could avoid in some ways by relying on contract labor.
And that's something like I've been through. I've been at a startup right when they got an influx of capital. They got $17 million and it was a hiring frenzy and expanded overnight. And then within a year needed to contract back down for a sale. And it was hard, it was hard on all the people who got laid off. It was hard on the people remaining, so it's definitely a thing that I know I think about when we are looking at expanding and things like that. That combination of what do I need long-term? What is maybe something that I can kind of scale up and scale down and maybe outsource that, to your point, to where I don't have, because there is morale and culture turmoil in some of those types of things. You also talked specifically, a lot about IT healthcare. And so I'd love to talk a little bit more about the IT part of that. When you're looking at a company and you said, as we said before at the beginning, you're already at the idea has been proven. You're probably in either prove the market or prove the product state where you're either expanding your product or really trying to define your market, pursue the market. From an IT standpoint assessment, and I know you don't necessarily do that, but I know, that is a factor that is quite in there. What are you looking for in an IT organization for that maturity to prove that you are being a good steward of going to be a good steward of that type of investment?
Mm-hmm. Well, again, as you touched on, I would caveat this with mentioning that I am not an engineer, nor someone with deep product chops, but we are relied upon to know enough about this realm in order to assess the viability of a product and the scalability of a company's tech function and the extendability of their product set. So, to answer your question directly, with regards to, the IT diligence that we conduct on a company and the specific points that we look to prove out, at the risk of overgeneralizing, and this is just talking about the healthcare IT companies and the tech-enabled services companies we invest in. We also do sort of pure services investing. But when we're looking at a prospective investment in the healthcare IT realm, we are seeking to take a company that might be sort of a little north of 5 million in revenue and try to assess whether we can take the execution risk on the management team to help that company get to 20 or 20 plus $million in revenue, I would say. And we regard there being just outside of the IT organization, just a transformation that occurs between a company that's sort of 5 million. I mean, there's a transformation that occurs between a company that's 1 million and 5 million in terms of mitigating some of that product risk and the market risk. A company going from 5 million to 20 million, there's a lot of transformation that occurs. It's sort of establishing itself as more of an industrial strength type of company that a lot of strategic acquirers would then look at and basically say, okay, if this company is able to serve that many customers, land, multiple sort of 7-figure total contract value contracts, go through the RFP, processes, go through info security audits, like all that stuff that is required to sort of get to 20 million in revenue, then a lot more possibilities open up for those type of companies, and that sort of migration is what we seek to help. So in terms of assessing on the IT side, what attributes we're looking for to determine whether a company can make the likelihood that a company can make that migration. We are looking to ascertain whether the company's current infrastructure and current team is capable of growing to, let's say, $100 million in revenue without major sort of wholesale product overhauls or wholesale team upgrades. And if there are, major upgrades that need to be done in the infrastructure or in the team, we'd like to kind of go into an investment eyes wide open as to what those may be, and to have those kind of frank discussions with the management team that we're backing, such that we can get alignment on, say, this company needs a new CTO, or this business utilizes a hosting platform, or a core aspect of the company's technology stack is really not going to be scalable, and that's going to be an added expense. Has the company sort of budgeted for that? So I would say those are two, the two key things that we look at. We look for IT processes and procedures. So, if on the use of proceeds of a $10 million raise, 4 million is going to be invested in product, well, it's really helpful for us to understand, how projects have been prioritized, how the company is conducting product development, and whether this is a business that is going to invest our company wisely, and kind of get through that prioritization queue in a structured manner, or if we're investing in a company that's been sort of cult of the founder personality, that there's been one person sort of making all of these decisions, and we'd be a little less comfortable with that. And then if that's the case, then the question is, well, is this the team that's coachable, that actually wants to learn from best in class companies elsewhere in our portfolio on how to sort of adapt that type of methodology? So hopefully that gives you a flavor of some things. I mean, there are a lot of other more technical things we look at specific to healthcare, like the protection of patient data, respecting HIPAA and PCI standards, looking at the certifications, is it SOC 2, is it high trust certified? If it's not, how important for what this company particularly does is getting one of those certifications.
Sure. So when these companies, again, we talked about they're in that prove that product part. The idea is already done. It needs to be scalable. A lot of times when you're in that startup phase, you take a lot of technical debt on. I make a
Tommy, I would just maybe make a refinement on what you said. We're looking for companies that have established a market fit, that they've proven that the product works, and then we're looking to prove out the sort of execution, so the distribution of the product, the company's ability to kind of scale that. Yeah.
Okay, so let me rephrase that. So when you're looking at these companies, they've got you want to see a good firm product base in there. They've got a well-defined market. They're ready to take it to that next level. We know a lot of companies exiting out of the prove the idea stage and entering into those stages. When you're in startup mode, you cut a lot of corners. It's all about burn rate, and maximizing, time to market. And so there might be a lot of technical debt. There might be a lot of things like that. And so what I'm hearing some of that, and again, this is getting a little technical in the weeds. But I'm sure that the company as a whole, when you're looking at, is the strength of that product. And I will say, again, from Ackland's standpoint, we're a product partner. We're not just, throw it over the wall and let us, and build something for you. We have to deal with that. We're in Nashville, which is a healthcare IT thing. We have a lot of people like that. So we do have to be thinking about HIPAA and thinking about, PHI information, those types of things. We have processes in place to keep separation of data and keep IP and data secure. And also helping, a lot of times we're a model. You come from a startup and like you said it, there's maybe a couple of leaders that kind of drive process, and it's very, driven by a person, which isn't scalable sometimes. And also, like you said, the people that got you to a certain point sometimes aren't the right people to get you to your next point. You might have a shift in those people. So we're also big on making sure there's a good blend of process and people to allow people to do their best work, and an environment that allows doing the right thing easy. So those are things that are passionate to me, and I'm thinking about, an agile software development is another part that's very special to me, that I think enables a lot of these things. How does that bubble up to someone at your level that's looking at that? Obviously, you're not going to, you're not going to be the one who's down in that, weeds. But how does that manifest itself in something that you look at and go, yeah, that's a good thing, or no, that's a little iffy? What does that look like to you from the outside?
It's a great question. And if I could just play the specific question back to you, I think you're asking, how does a company's kind of comparative or relative strengths in the realm of product management, decision-making around product manifest itself or sort of reveal itself when we're looking at a company to make a prospective investment? Is that the question? Yeah. So I think there's a couple things, we can look at. So, one is, what is the capital raising history of this company before we go in? And, how capital efficient has this company been? we understand that the path to success for a startup is not linear. It can be like a little circuitous. And it's possible that, and so that's one premise. Another premise is, we also understand that product, like it, particularly in the early days of a company, represents the majority of the expense of the capital that goes in, because they're, they have the idea and then they're building the product. And so I think we're looking for, okay, like are we investing in a company that raised a ton of money before we went in and spent it on a bunch of projects really fast that didn't have viability, and they sunset those projects, and now they're sort of changing their idea and sort of trying to do round two with a new premise of what the product should be. And I think the question is, okay, does the existing capital that was deployed in all of these projects suggest that there's a lack of order, a sloppiness, chaotic, decision making in terms of product market spend? Or does it suggest that no, there actually was order? This company was pursuing very deliberately an investment strategy in their product, and then maybe the market moved away, from them, or maybe they decided deliberately to sort of jettison, part of their business and invest more heavily in another. I mean, there are good stories for why a company might have invested a lot in product despite not being, being very, very early revenue. And so, but I think that is, if a company has raised a lot of money to get to a very low revenue threshold, that is something that we will then begin asking questions on. Okay, well, is this reflective of the product management organization as a whole? And if we invest money in this, will our money be invested wisely? So I would say that's, one point to answer your question. A second is, on the flip side, we're really valuing founder financed companies, and the reason being kind of obvious that if a founder is spending her or his own money, they're typically exhibiting frugality and discipline, and only spending it where it needs to be. And in those cases, you mentioned technical debt. I gave you the first example of a company that might have spent capital too quickly and haphazardly, on product. In the founder finance bucket, I think one needs to look at the possible inverse, which is, okay, if this is a business that has only raised money from the founders and has won several large contracts, are there loose ends? Are there things around the safeguarding of data security, that we should go and take a closer look at, because the business has been so thinly capitalized, to date. And then there's a whole bunch, sort of in the middle. The last thing I would mention is, you've got many different flavors of founding teams. You've got one sort of paradigm of the very technical co-founder who might be the CTO, coupled with the more business-minded commercial marketing founder who might be the CEO. I don't think that that's an overgeneralization to say that that's a very common type of startup. And, in those cases, if the CEO is the one leading the capital raise discussion, but the CTO is the one who's sort of in charge of spending the money on a bunch of product, getting a little bit into that dynamic and, understanding, is the CEO appropriately deferential to the CTO in making those decisions? Is the buck stops with the CEO? Is the CEO overbearing, in that regard? Does she or he sort of understand the product well enough to, weigh in on decisions? that whole sort of around product investment, that whole balance is something we really look at.
Sure, and I've been in plenty of those where you, like you said, you have the business-minded person, the technical-minded person. They kind of automatically fall into the CEO, CTO, CIO positions, and it is a tenuous balance. And and I've been part of that where I have been the tether. Someone has great ideas and they're always wanting to go and do the next big thing. And I'm the one who's supposed to kind of come and say, all right, well, maybe we do this, maybe not all of this, maybe this part. And that thing is great, but it's going to cost this much.
Yeah.
And I think you're right. It's the relationship between those is very important just on a personal basis. But then I would think looking from the outside and trying to, I've been on the inside trying to build these things, how strategy is communicated, how it's created, is that done haphazardly? Like Ackland right now is doing EOS, and that's, I know that's an attractive thing sometimes people see because at least shows some type of formality and process around taking large strategic ideas, breaking them down into, L10 and things called rocks and stuff like that, putting OKRs in place, and kind of putting that balance in there. Is that something, so things like EOS, and there's a bunch of other ones in there. Is that a thing that when you see that is attractive, or is it kind of depend on, you could say you're doing this, but it may be horribly implemented? What are your thoughts when you see those types of things, a structure that might hint to there's at least some kind of deliberateness about how that happens?
It's a positive. I mean, whenever we see at the stage of company in which we invest, if we are seeing, progress being done towards on a pre-closing, basis, towards one of the various management methodologies that you've, outlined, OKRs, just to use, an example, that suggests that there's at least a culture, in place where, if they learn the examples of other companies, in our portfolio that have really kind of, done, rolled out those types of methodologies in a successful way, if they've experimented with those, or perhaps they've already been very successful in rolling those out, before we invest, it's usually a good indicator of success on the back end. I would say that there is a lot of force fitting of those types of methodologies as well. And there's a lot of, it can be dangerous when a CEO, a board asks the CEO to roll out something like that. The CEO leans very heavily on her or his people. They do a big amount of effort to the launch. They determine that they've picked the wrong indicators. They determine that they can't track the indicators. And all of a sudden, the CEO has lost credibility with his direct reports. And the board has lost some credibility with the CEO. There's some risks, to sort of, non-genuine or excessively heavy-handed, modes of those.
And I've seen those as well, where it's more about the practice than the principles. And we even see that, like I mentioned Agile software development before, Agile's become very popular. It's now something that most people are looking at as a strategic advantage. But again, some places still do things the old way they've done it and just put the new names on it. They just have adopted practices, but really haven't done the principles. I know also when we do product development partnerships with people, and just in my career in general, like I remember being a young man going to a Fortune 50 company and thinking, wow, I'm going to really see how things are done well. And 3 months into it, I'm like, how the heck are you people still in business? This is chaos. And so it's sometimes when we do these partnerships, especially with companies that are in their earlier growth stages, we can we are big fans of product visioning, personas and goals, really being user focused. How is this feature I'm doing going to help this persona get to his goal? And then if I get that persona to goal, how am I going to monetize that? It either protects revenue, creates revenue, avoids costs or decrease costs.
Yeah.
It doesn't make dollars, it doesn't make sense. And seeing someone who has any kind of methodology or any kind of practice, no matter what it's called, that helps distill that down and still be going towards your North Star, we feel is good. And a lot of times we've come into companies that really haven't had that. We've been able to kind of, I may not know your domain, but I know product development really well. And I can get product development or hold up a mirror to you and go, is that really the thing you want to do?
Yeah.
Is that the most important thing?
Yep. And I would just add to what you said, just in thinking it through, and I'm not sure if this is a direct response to this question or the previous one. But I think, a way of thinking about like what investors value as important from a technical perspective in a company that they're about to invest in is thinking about when we sell a company to a strategic acquirer, like what are going to be the most important attributes of that, technical attributes of that company to another technology company, a healthcare IT company that's buying a smaller healthcare IT company, as an example. And so, some of those are, the assignability of the contracts, that's sort of partially technical, partially sort of legal term, but another is, around the decision-making process on product management. Is this a company that is listening to its customers, and maybe, and I know that Agile has sort of aspects of quickly incorporating customer feedback into product development decisions, but that buyers end up looking into that. Well, I think you could generally think about like the most conservative view that a strategic acquirer could take. Companies got to assume that like every line of their code is going to be fed through Black Duck or sort of an equivalent. They're going to be scanning for sort of open source use of open source code. If there is open source code being used, asking the company to sort of represent put representations around that. Data rights is another kind of thing. A lot of healthcare IT companies are doing one thing in service of a bigger sort of data aggregation strategy, either on population health or real world evidence. And so, thinking through like, is this company both protecting the data, but also, licensed to use the data in the way that they're, using it?
So definitely, I understand it absolutely as a software product vendor, using people's data correctly, PHI scrub, we found that the best way is we've gotten really good at scrubbing data. Sometimes there's all these, we can set up VPNs, we can set up this write access. We found the best way is keep that in production and have good scrubbing techniques to bring production-like data, but that is, sanitized into dev environments, stage environments, those types of things. Also, constantly doing, in our build pipelines, things like an OWASP scan, which is another kind of security scan and those types of things. And we find that that's a thing that it's really good to build from the start, build quality in. The lean idea of build quality in as part of, I don't care if I'm building the smallest thing, make sure that it has good quality in there. And I also want to speak to one thing you touched on and kind of go back to what we talked about before is deliberateness and switching, abandoning things. It's not bad to abandon something that's not making money. And I've been in so many companies that, it's the sunk cost, it's the sucker bet in Vegas. I'm already, this much money in, I should just go ahead and spend the rest of the money. I've been at some places that have done that. I've been at some places that I saw them very maturely not do that. I was in a place, they implemented this very complicated reporting system and forecasting system, and it's based on all this, proven math and things like that, but put it out there and just the normal everyday person couldn't grasp it. It was just too hard. At the end of the day, I'm not a mathematician, and you kind of had to be that way. And they revealed it, and everybody went meh. And so there was a little bit of discussion of, can we tweak it? Can we do this? But it was very early on that the customer did not like it, and let's let it go. It's like, what is that? Marie Kondo, does this spark joy?
Oh,
No,
right,
thank
right.
it, let it go.
I'm thinking about that a lot. I'm moving out of my apartment to a house right now, and I'm like, yeah, it doesn't bring me joy. None of this stuff.
And it's an important part for a company. It's an important part for a growing company. As
Yeah.
you said, when they move from certain stages to another, things that got you, think processes, tools, people, unfortunately, sometimes that got you from one place to another are not the people, process, and tools to get you from one place to the next. I've found, I have a unique role as chief agility officer here at Ackland, and I actually, do that role. I'm on part of the executive team. I ran HR for a while to kind of help make sure Agile was in there. I worked as CTO. I worked with sales to make sure that those principles are just part of how our thinking is from day one as a company. And knowing when we need to pivot, knowing when we need to let something go is so important. It's hard. And I don't know, maybe this is, I don't know how deep we can go in this question, but I wonder, because I don't know how long you observe things after you've made that investment and people are making that switch back and they are having to let some of those things go. That's hard. What have you observed when people make that switch and there have to be significant changes in the company? How do you observe, number one, maybe you kind of, are there things you look at to say, I think they'll weather this well because they'll be able to react well to it? And do you ever kind of look afterwards and kind of see they did this well or did not do that change well?
Yeah, I mean, it's a weighty question. And, we certainly reflect on lessons. We have a formal lessons learned sort of reflection exercise for all of our investments. But, I think your specific question would be in the realm of, companies deciding to back away from major product initiatives they might have sunk a lot of money, into, and, just sort of go down a separate path. I would say that when the motivation or the impulse for a company that has raised a bunch of money and might have access to more money is to spend it. Typically the impulse of a company that doesn't have access to a lot of money or might not in these sort of future uncertain capital markets that we've talked about, is to think about how they can do more with less and how they can sort of maybe step away from some opportunities on the revenue side because they're not going to be able to service this kind of revenue because they can't ratchet up a burn rate to service revenue, just the way these sort of working capital dynamics work in these companies. So I would say that when a CEO approaches us and they say, hey, we're going to sunset this product that we've spent a lot of money into, or even more extreme, this customer is no longer strategic to us. They're using a legacy version of this product that we're not going to invest in anymore. We might want to fire this customer or sell them the instance of their source code. That we usually take that to be a sign of maturity. Because it's something that is so counter to the sort of growth at any cost mentality that can plague a lot of startups. That by the time a CEO brings that decision to her or his board, it's typically something that the board does their job and can ask the appropriate questions on. But we kind of view that as a sign of health, making those types of trade-offs.
Sure. And I remember, years ago getting my first exposure to that, working with chief revenue officers and being at a company that was going through this transition where we had lots of little clients, lots of small clients with, they're very dedicated and we love them, but we were shifting to an enterprise client.
Yeah.
And I can get 2 or 3 of those and make my numbers, but the cost of acquisition is so high that trying to get 50 of these other smaller ones just doesn't make sense.
Right.
And there was this very specific, deliberate decision to say, we're going to stop marketing to those people. We're going to stop maybe relicensing. We're going to sometimes it's a little passive aggressive. We're going to price them out. We're going to raise our prices. So we'll probably just naturally lose some of those people. But it's hard because those are some of the people that were with you from the start.
Yeah.
But again, those aren't necessarily the customers that get you to the next thing. And I think it's, like you said, a sign of maturity. And also, the way you were describing earlier about a company doing more with less strikes a chord with me in lean. I'm a big lean guy. And so you think about, Japan, being, inventing the Toyota production system, lean manufacturing after World War II, because their infrastructure was gone. They had to do more with less. And America being fat and happy and not, and lean, we had introduced lean and all that, Edwards Deming and all these guys, but America wasn't eating its own dog food because we had so much money. Why care? And you kind of pointed to that. People, I get this influx of cash and I'm like, oh, I don't need to be lean. I just, I need to spend and do more. And then, like we talked about how sometimes you see that spend, and suddenly there's, oh crap, and then a contraction and having to go back to lean. And when we work with companies, I use a term called ruthless prioritization. And I'm not allowed to say it in sales meetings anymore, but I used to say, just assume you're going to fail. Just assume that, and maybe it's a pessimistic attitude, but it makes you, I'm not a very Pollyanna guy. And I'm like, I can always add more in, but I can never get time back for stuff I wasted on things that wasn't needed.
Yeah.
So, I'm a big lean guy. And so, you have lean startup, you have a lot of that stuff's out there. Lean is kind of a, cousin to agile. They have a lot of overlap. Is that something? I've also know that, like, a lot of business people know that because it's been around for a long time. Is that another thing that's maybe attractive when you hear kind of people using some of the ideas that came out of lean product development?
Yeah, I would say that any cohesive sort of management methodology or that is with embraced, or where there are signs that it's embraced beyond just the sort of CEO or just the CEO and the SLT layer is a positive. I think just to ladder it up, there are companies that routinely make their numbers, and then there are just at the highest level revenue and EBITDA, and then there are companies that routinely don't, and of the subset that do, I think what is required for a company to make their numbers? Well, a company needs to perform, but making your numbers by definition means that the company is able to forecast and predict their needs with accuracy, and convince the board to approve a budget that's sufficiently ambitious but attainable. And if that predictability is being achieved by lean or by agile or by some kind of OKR methodology, then we're very supportive of that. If it's a company that regularly sort of misses and is seeking to institute a management methodology along the lines of what we've discussed as a way to begin predicting kind of better, I think that that's sort of a different type of situation that we might want to learn kind of more about. But I think a lot of these terms are sometimes overused, maybe is another way to do it. But we've seen tremendously positive results be achieved by companies using some of those systems.
So to kind of start bringing us down to a landing, if I am somebody, an executive, or at a healthcare tech company, and I'm listening to all of this, what is kind of your last advice for me? I am hopefully trying to get some capital, but maybe I can, maybe I can't. What is your advice for me? You've touched on a couple of different things. How would you kind of maybe succinctly in a couple of points round off that advice?
Sure. Maybe as a broader point that's a little bit outside of the realm of what we've discussed, this COVID-19 pandemic, shined, a huge light on the deficiencies of our healthcare system. And in 2020 and 2021, and that translated into just a tremendous, favoring of this category in the capital markets. A lot of capital went in, a lot of startups got sold. There were a lot of IPOs. Healthcare IT was regarded as sort of a panacea type of solution to the ails of our public health system. Now, as the capital markets have contracted, there are questions as to, whether, say, the promise of virtual care was being a little overstated as a solution to, the access issues, or whether remote patient monitoring is going to have a future, beyond, very specific sort of needs, of hospital systems. But I would say that regardless of how one feels about whether there was sort of this bubble mentality that COVID created about healthcare IT, unquestionably there were advances in the utilization of healthcare technology that are going to be sustainable. And you can look at, the percentage of visits that are done virtually now versus pre-pandemic 2019. It's a lot higher. It's not as high as it was during the kind of COVID peak. I think you can look across a lot of categories of digital health and say that there was this tremendous boost to digital health that occurred in the pandemic. So if you're an entrepreneur and you're thinking that the tide has really turned away from the sort of heyday of the peak market, 2021, I would say that, we are still viewing the healthcare IT category with a lot of enthusiasm, and that we think that there's going to be a lot of opportunities for entrepreneurs, to raise capital, to acquire other companies, to make a real impact, in ways that, actually weren't available before the pandemic. I think that what I would stress is, maintaining optionality is key. All companies go out of business for the same reason, because they run out of money. And that finding ways to extend cash runway, either through customer financing, through making tough decisions on the cost line in austerity measures, through just seeking to get to that next inflection point, understanding that the market might not be giving the type of valuation credit that companies are seeking right now, I think is important. So remaining nimble, able to execute on mini pivots, able to consider perhaps an earlier exit than what might otherwise have been anticipated, and maintaining faith and confidence that the market has embraced healthcare technology, and as multiples settle out away from their kind of current troughs, we think that those companies that are executing on the key metrics of maintaining minimum sort of revenue growth above a certain threshold, maintaining low customer acquisition cost that's materially lower than customer lifetime value, keeping gross margins above a certain threshold. Those companies will be rewarded in any market, but particularly in a future market after this kind of current economic moment passes.
Perfect. Well, Ezra, thanks so much for taking time to chat with us. I know we wandered the desert for a little while and touched on a lot of different things. To wrap up again, why don't you let everybody kind of know what you're doing, how they can find you if they're interested.
Sure. Well, thanks again, Tommy. It was fun wandering the desert, to use your terminology there. Ezra Mehlman, I can be found on LinkedIn. I'm not on Twitter. I can find on the Health Enterprise Partners website, and I'm a partner at Health Enterprise Partners. We're a healthcare IT and services focused growth equity firm, and look forward to meeting entrepreneurs making an impact in innovating healthcare in the United States and abroad.
Perfect. And I'll remind everybody, I'm Tommy Norman, Chief Agility Officer at Ackland Avenue. We are a custom software development shop specializing in nimble, agile teams and staff aug. And so we're interested in people who need all that help we just talked about building that right product, and some guidance in there. So I really thank everyone for tuning in, and we'll talk to you next time.